Can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. With me today, as you can see, I've got Dr. Friday in the house because we're going to be talking about some of this new tax reform. Looks like tax legislation's moving forward. There's still going to be, of course, some tweaking. We're not sure exactly what that's going to look like yet, but we're going to address some of the things that are in the two bills, both the House bill and the Senate bill, and how that might shake out for you as far as taxes next year. One of the things to look at, by the way, when it comes to taxes, is understanding too what it's going to mean with regard to how it affects you. So if you're at or near retirement or in retirement, these are some of the things we look at, for instance, on the standard deduction, what you would get, or what you have been able to get under the old tax law, and what it's going to look like under the new tax law. Are you going to benefit? Is it going to hurt you a little bit? You know, how's that going to, is it going to be maybe a wash even? We're going to look into that as well. And then, of course, some strategies when it comes to taxes. How can you reduce your taxes? How can you keep more of that money in your pocket and less of it going out to the IRS? All right, one of the things that comes into play, by the way, when I'm going to share some statistics here. Median household income rose to $59,039, which is a record. It broke the record set in 1999 of $58,655. Well, again, this is not a huge jump, a few $100s, but here's something to take away even more telling than that. And keeping in mind, too, when they're saying $59,000 and are comparing it to 18 years ago, this thing called inflation, and that has gone up quite a bit more than what incomes have. They have not, of course, stayed pace. In fact, if anything, the exact opposite, which means, of course, people are, exactly, expenses are going up and your income's not keeping pace, which means you're having to either work more or spend less, not being able to use it. Also, this is something that shows in that 78% of Americans are living paycheck to paycheck. 78%, okay? So here's another part of that. 50% of Americans, half, all right, could not afford a $500 emergency. This, again, is very telling in terms of thinking as far as taxes again. So people living paycheck to paycheck, people only making, especially if you're talking about on a $50,000 income, tax-wise, what does that even look like, right? After you're not going to be paying, of course, as much. If you're having difficulty, and this depends, of course, if it's family of four trying to live on 50, I can't even imagine, you know, how difficult that would even be to attempt. All right, so here's the other part. 86% of Americans, and this kind of feeds in, right, have less than $100,000 in assets. So when we're talking about all this tax reform, who's it going to really affect? Well, new middle class, according to the study, is those with $500,000 or more in assets. In fact, they're saying from $500,000 to $20 million is what they're talking about. That's a pretty wide range for a middle class, right, for assets. But here's the other, what we're looking at is that means more in terms of taxes. If we see what's going on with the government, we see the kind of things as far as deficits and the debt that we have, and they need the revenue. Where is that revenue going to come from? All right. Now, one of the things we're talking about is, of course, broadening the tax base, which could help with this. Yes. But the other part is, what do you know, as far as taxes go, if think in terms of your own tax planning and the importance it's going to be for you more and more, as you see less people being able to, where does the government go if they need tax revenue? It's not going to be to the people that don't have anything, is it? It's going to be to those that do.
Yeah, well, I mean, we know that the highest 5% of people working, or the highest earners, are the major payers of the taxes right now. So when you're looking at tax reform, I know everyone always says the lower and middle class need more or would like to keep more in their pocket, but the fact is they're not putting out as much. So they're making adjustments right now in the system. So if you're in the low income, this tax reform is going to have probably a very small effect because you're not really paying anything in, so you're not going to lose anything, but they're increasing the child credit, things like that. But most of the things they're increasing isn't going to be refundable. So it's going to reduce the bill, so they'll have still very little or zero tax, but they're not going to actually be getting more money back from the government at the end of the year, which right now, if you have a family of 3 and you're head of household, theoretically you could be getting like $12,000 a year. That's a lot of money to be bringing back in not paying anything in, you know. So one of the ways they're trying to reduce the deficit is to maybe reduce some of those credits. Now, of course, the wealthier, the ones that are in the higher, they are giving some breaks, but the marriage penalty basically hits the 35% tax bracket, and that's the people that are in the 250,000 to 260. I think that actually hits. It's funny. It's 200,000, I believe, for the individual, and then it's like 260,000 for the married. So yeah, it's 200,000 for an individual, 260 for a married. That's what starts the 35% tax bracket. So, and then after that, the 39.6 goes back to no marriage penalty. So there's only a marriage penalty in what they're considering, again, hitting that upper middle class income. So those are the ones that are going to hit. If you're in, you know, less than that, you're basically, there's no marriage penalties. That's pretty straightforward. A single person will get 45,000, a married couple will get 90,000. Makes the playing fields, but there's going to be no itemizing in this new one. Pretty much, you're going to go from 21% of people that itemize down to roughly 4%. And I think that's going to be in states where there's a lot more higher property taxes, mortgage interest, because they're really eliminating a large chunk of all of that in this preliminary bill. Let's point out this is not anything that's passed. It's just the first one that's been brought out by the House.
And that's the other part. When we're looking at tax reform, of course, how are they going to shake out some of the things? We'll talk about some of the controversial things, such as they've talked about limiting mortgage interest deduction, the property tax deduction, and in particular in certain states that are going to be impacted by that more so than in others, right, what that would look like. I think they're going to, you know, as with anything, they always come up with compromises. So we're looking at that. That's it, exactly. We got to come together, and so usually it's like if we're high on one side and low on the other, they're going to bring it to the middle. Right. Here, the thing for you to think about, though, with regard to taxes is understanding the progressive system that tax system that we currently have. Right. And this is one of the areas when we talk about talk about tax brackets, for instance. What does that really mean as far as tax rates? The effective tax rate that you're paying is going to be lower than the highest tax bracket that you're in. Right. And the reason for that is whether you're looking at the old plan, let's say, or the current plan. Right now, as an example, if you're for a couple, let's say age 65, what you're looking at there, and this can apply for, we'll say first off for just a couple, right? Under 65, you've got standard deduction of $12,700. Right. If you're over 65, you add for each of you $1,250. So for a couple again over 65, that's $2,500 added to that, which would give you now $15,200. Yes, $15,200 that you pay no tax on. All right. Then you have exemptions. So again, for a couple, that's $4,050 each, or $8,100. So you add that to the $15,300. Now you're at $23,400 that you're paying no tax on. Did I get that right? $23,900. 22, 25, 12, 14, 15, 2. Yep. Actually, okay. $23,300. Okay. So you got $23,300. Okay, that you paid no tax. You get between your standard deduction exemption. First $23,300, zero tax. Right. Next, for a couple, approximately a little over $18,000. I think it's $18,650. You pay 10%. All right. So you're in a 10% bracket. Let's say, at that point, you've got a total of $41,000. We'll call it $42,000. $42,000 in income, and you've paid $1,800 in tax on that. So again, if you did do the math on that, that comes out to about a little over, somewhere between 4 and 5%, let's say, is the effective tax rate. Right. All right, so you're in a 10% bracket, but your effective tax rate's less than 5. And as you do the next bracket you go up is the 15% bracket, and that's going to, so this is where it comes in for most clients, all right? For most people that I talk to, I know, we're looking at that edge a lot of times of $100,000 a year. So at $100,000 a year, how much? You're basically, in that scenario, you're still in the 15% bracket. Because by the time you finish with the, again, standard deduction, exemption, the others, so bracket, you're looking at about, let's see, again, 20, 55, was it about somewhere around $8,000, let's say, on, $8,000 or $9,000 on $100,000. So again, you're down below 10% in terms of total tax, or your effective tax rate. And this is real important because that 15% bracket comes into play in other ways as well with regard to capital gains taxes and other things. So when we get into tax planning, when we talk about Roth conversions, when we get into a lot of the different things that we do to help you reduce taxes, it's real important to understand these numbers and how it works, all right? So we're going to get into that a little bit more and show you, in fact, why it's so important and how you can, in fact, just through proper planning, keep your taxes at an absolute minimum, which is what we want to do, right? Who wants to give more to the IRS? Not me. All right, we're going to show you how to keep more of your money in your pocket when we return. But first, we're going to take a quick break. Join us here. We'll be right back on the Retirement Report.
This is a Storm 5